Today, I want to go back and look at our investment theory that once Liberation Day came along, that money, big money, started to move out of America. And we said there's only X amount of choices. You can go to Europe, you can go to Japan, you can go to China. And then you have these two other things, the Swiss franc and gold, which had, well, they moved up and now they're kind of jostling around, still up. And then, of course, Bitcoin, which has been hanging in there steady. So, is this actually happening? I mean, the dollar is down 9%, it's down 7%. But why don't we go through and see what numbers we know today to see if this is actually a valid investment theory? So the Financial Times starts off saying selling dollar assets signals the start of a longer term shift. And so the first paragraph, states which we have said here is that the asset managers have a huge percent of exposure of their total assets to the US dollar. We felt that was going to come down. We didn't say it was going to go away. We asked, is it going to be 5, 10, 15, 20%, whatever it may be. So now the stocks have recovered since Liberation Day, but the dollar is still down 7%. And you can see here that the European stocks have been lifted and have outperformed the S&P since Liberation Day. It's a stark thing there. And I'll just point out in the first paragraph here, it is happening. It'll be slow but inevitable. And anybody who's been following us, I say, look, this is a minimum of a 5-year, maybe a 10-year process. The article goes on to point out that in Europe, buying European ETFs that are invested in America had a $2.5 billion European outflow, something they have not seen in years, okay? And not only is the European stock market going up, but so is the euro is going up. I'm only going to point out in the first paragraph here that this gentleman's name, who I'm not going to try to pronounce, says that the bank has started seeing real money, institutional dollar selling. This is what I'm saying. When you look at the world in investing, there's real money. The big asset managers, the sovereign funds, the big family offices, these are the people who make long-term decisions, not short-term decisions. And the big money is now moving from the United States. And it says, we see significant selling of US dollars from real money investors over the last 3 months. And this gentleman here runs a $149 billion Australian pension fund, SHEAM they call it, seems like it should be fund. He says, frankly, I think we have seen the peak investment of US assets. We always look to quantify things here. So in the second paragraph here, the Sam Litton Brown says that if the pension funds were to reduce their positions back to 2015, it would be a total of $300 billion euros in dollar assets. And he points out that for years, the U.S. has been a beneficiary of vast capital inflows. I keep pointing out, last year, 2024, 74 cents of every single dollar, yen, euro invested in the world was invested in the United States. I don't think we're going to hit 50% this time. But as we stated, this last line is critically important. There are limits to how far this trend can go, analysts say, given the depth and liquidity of the U.S. stock market and the near $30 trillion in the Treasury market. And as we pointed out, we said that, the two main places we felt would be the euro and the yen. And as you can see here, that over the last couple of weeks, that $57 billion has flowed into the Japanese markets, which again, I believe is replacing U.S. assets. And Japan has had 15 consecutive days of up markets. I'm not saying it's going to continue. I'm saying as the major money in the world reallocate their assets, we will see moves like this, okay? So why is this happening? You can see here that, this Kathleen asked a major question, which we all have to answer. Are the United States Treasuries are either a global reserve asset or a debased debt investment subject to unilateral default and term revision by the issuer? It can't be both. And here Gunlack met with Besant, and Besant said to him that we're going to have an adversarial debt restructuring. And Gunlack remarked that Besant's idea on restructuring Treasury debt by extending maturity, the 100-year bond, slashing coupon, 0 coupons, we don't pay them any interest, for foreign bondholders could deter investors from the U.S. government bonds for generations. Okay, so what does this all mean to us? We can see the dollar's down, the euro's up, the yen is up. Their money is going into their stock markets and it's kind of leaving ours. Yes, we just rallied because of the China-American deal, but as we said before, we don't believe that you should invest in the markets according to what the tariffs are doing. It's best to watch the big money. So the big money is cutting their exposure to the United States. It's as simple as that. And so that is going to be a drag on us. And, where do you invest? People keep asking me that. Listen, look at Buffett. Everyone's going crazy. Oh, Buffett has whatever the amount of money is. It's $400 billion or whatever it is in cash, right? His record amount. All true. Except that no one ever mentions the other side of the trade. He's still 65% invested. So we all have seen the numbers for the last 50 years that it's best to remain invested in the market. The question is what percent that you're invested in the market, and do you do any counter investing, saying, well, if this goes wrong, then this will go up, right? These are decisions that you have to make. But our government has to make decisions also. So the Moran paper is really clear that they definitely want to introduce this 100-year bond on foreign holders of treasuries and pay no interest and make it a 0 coupon so we can cut our interest rate payments. And this has everyone obviously very questioning their position with the U.S. Treasuries. Now, I know there's been huge discussions, especially when we had our issues on that Monday, that the Japanese are selling our bonds, that the Chinese are selling our bonds, they're actually selling the euro dollars to Brussels and all this other stuff. It's not true, okay? It's just not true. It's easy for us to understand and then place the blame on somebody else that they're selling our bonds, causing us to have problems. Not that we're putting tariffs on them and causing them to have problems. And so really what's happening here is that I'm not worried about these people selling their bonds unless we actually do introduce a 100-year bond and have a forced conversion, 0 coupon bond. What I'm worried about, and I've stated consistently, if they start cutting their purchases of U.S. Treasuries. Now, I know it's just 3 data points from last week where the 3-year, the 10-year, and the 30-year that the Fed bought on the auctions for a total of, I think, $43.4 billion, okay? And it's a data point. I know people argued, I have them on my X feed and everything, saying there's no QE. It's not QE because the balance sheet isn't going up, okay? Well, we shall see on that. I believe that it is QE because we're buying bonds in the open market to support our interest rates. Because if we didn't buy them, we may have had higher interest rates. That's QE, no matter how you cut the pie. So here we are. We're faced now with a situation where we know the big money is moving away. And we put on these tariffs, and these tariffs, no matter what anybody says, are at like an all-time. We haven't been this high since the 30s when we crashed the global economy, okay? So the question is we're giving them less dollars because of the tariffs. And that means there's going to be less dollars to buy the U.S. Treasuries. And by the way, they're going to cut their purchases of the U.S. Treasury with their less dollars. What do you think? Like and follow.